Thank you for joining us. It's a great session that we have for you today. It's with Chris Crawford, the managing partner of Crawford Fund Management based in Boston. Chris, welcome.
Thank you very much.
Such a pleasure to have you here today to learn more about your investment approach. Before we do that, tell us a bit about how you got started in the business and how you got interested in investing.
Mm-hmm. Sure, absolutely. It was a very young age. I bought my first stock when I was about 10 years old from money I earned mowing lawns and various other ventures as a kid. Always loved the stock market. My first stock, I think, was a utility stock, and just always loved following the markets. And went away to college and didn't realize you could actually have a career picking stocks. I thought it was something you just did on your own or through a broker. There wasn't really a well-established career path for people in undergraduate schools to go out and do this professionally. So I went in my first job in consulting, management consulting, doing strategy operations projects, mostly for big corporations in a variety of industries. It was a great learning experience. Got a lot of exposure to the issues that companies face, how to grow, how to retrench, how to reorganize. Got a lot of exposure to some great executives. Went back to business school and used that as a transition in my career to formally go into money management. So worked initially in a big firm called Wellington in Boston, long history of managing mutual funds and institutional money. Started off as an analyst following the media industry, branched out a little bit, followed some adjacent industries, got my first experience running money at that firm, both institutional accounts as well as a mutual fund. A lot of great exposure to really successful investors. The firm has a wonderful research culture, and I got to be around some really great, long-time, multi-decade, legendary type investors and absorb a lot of knowledge and learn from my own mistakes, learn from mistakes other folks made, great learning environment. Then had an opportunity to work in a hedge fund business as a senior analyst, again exposure to great investors. First opportunity to learn about hedging and the short side and using options to manage exposures alongside the long book. Another great experience. Spent some years at Putnam Investments, managing mutual funds there in the international space, and then ran a portfolio for Stark Investments. I was a multi-billion-dollar multi-strategy hedge fund. I ran the equity portion of their business with a team in Boston. And finally, about 4 years ago, with some colleagues, we decided we'd follow a long-held dream to start our own business and invest on a smaller scale, take all of the knowledge and experience we gained over the years and apply it to a smaller, more nimble fund. We put our own capital in, so we're eating our own cooking, and be able to follow the most creative ideas, go off the beaten path, find more eclectic things that you can't do in a big institutional setting.
Also, a lot of experience here, and also I detect that opportunistic approach and staying disciplined as a value investor at the same time. So I look forward to learning more about that approach of yours. Well, Chris, you talked about the importance of mastering multiple investment approaches, and as a value investor, I'd be curious to hear about your approach to value and how do you master various different approaches to uncovering value, yet remaining disciplined and not straying off the course. So tell us a bit about the various investment approaches and how do you take them together into one approach that you apply.
Mm-hmm. Well, I think there are a number of different approaches to investing. There are a lot of different ways to succeed in this business. If you just look out at the successful investors, there's many different ways that it's done. I think one of the key things is there's a page in a great baseball book by Ted Williams called The Science of Hitting, where he has a picture of his strike zone broken down into his batting average at different points in the strike zone. And the concept is knowing what you're good at and what you're not good at, and not swinging at the pitches that come in areas where you don't have a history of success, and going after the things where you have a history of success. So I think the main thing is to know what you're good at and what you're not good at. And once you've done that, if you can be good at multiple things, then you're going to have more opportunities available to you. The market rewards different types of investing, different styles at different times. Sometimes it rewards deep value investing, sometimes it rewards momentum investing, sometimes growth investing. So if you can be able to recognize different types of opportunities, you're going to be able to have more stability in your portfolio because you'll have a balance of different ideas. You'll be able to arbitrage between different types of opportunities because as some are fully recognized, others may be not recognized, and you can recycle capital between these types of ideas. So I think it's important to be good at a few things. In terms of developing that expertise, it just takes a lot of time of going out, researching ideas, investing in ideas, seeing the results, both the successes and the failures, and learning from them, and focusing in on those areas where your probabilities are higher. So for me, the types of ideas I like to look at, my favorite type of long investment is what I would call a wealth compounder. It's a business that you find young in its life cycle, that has a large, long growth opportunity in front of it, where it can grow its top line, it can scale its operating structure, scale its margins, and create an increasing value at an increasing rate over time. And finding it when it's a small company. Those businesses are great because you can grow with it, you don't have to spend as much labor finding new ideas, and it's very tax efficient because you're compounding the value and not paying taxes until far into the future. And there's a whole series of key things you need to know in recognizing those types of businesses and in avoiding the pitfalls in those types of companies as well. The key things being the internal reinvestment opportunities of the business. It takes a lot of work to understand those opportunities. So that's one type of investment, the wealth compounder. Another type of investment I would call the margin of safety value investment. This is finding maybe a more mature business that's trading at a steep discount to its intrinsic value. Franchise companies that have a solid market position, they might dominate a niche or even be a bigger company, but they have a protected moat around their business and they can generate free cash flows year after year. And at various times, these companies come in and out of favor. They might have business-specific issues, a temporary setback in their business that are causing the market to be temporarily pessimistic. It's identifying those businesses at a time when the markets cast them aside. So that's another type. The other type I like to look at are what I'd call some of the parts or hidden value type of investments, where you've got a business that's a rather complex company that has several different things it's doing. It might own a cash-generating business, but it might also have other assets that are not immediately obvious. It could be a money-losing division they've been investing in that are actually burdening their earnings, but the business has positive value. So if you're just superficially looking at the company on traditional metrics, PE ratios and the like, you may not see this value sitting inside the company. Another type of company might be someone with a large NOL built up, a tax asset that can be monetized or utilized. So identifying those hidden values. On the short side, the hedging side of investing, there's also multiple different types of theses types that you should focus on. For us, one is finding a flawed business model. So you have these waves of IPOs that come a couple of times every decade. There's a big IPO wave. And each time it's a different series of hot themes or hot industries that Wall Street promotes and goes out, and it's usually a germ of a good idea gets taken to excess. And over the years, it's been, back in the internet bubble, you had the B2B companies, the business-to-consumer internet companies, the e-tailers, and then you had a big boom in telecom equipment companies. There was a microbrewery fad. There's always a hot theme being played. Today it's things like cloud computing. 5 years ago it was E&P gas drilling companies. There's always a series of companies that get taken public, and within these hot themes you tend to find the lower quality merchandise comes to market later, and there's flawed business models, unproven business models, many of which don't end up being successful. Something like 20% of all companies that are taken public are delisted within 5 years. So there's a lot of failure that's out there in the market. So having a keen eye towards business models that are not going to work is one short thesis type. Another one is extreme overvaluation. You also get markets like 1999 where you get extreme valuations that are mathematically impossible. These are tricky because there's nothing that limits how overvalued these businesses can get in the near term. It may be inevitable that the valuation can't be supported, or that the insiders keep selling more stock. There are forces that ultimately correct these valuations, but those can be trickier and more treacherous. But that is an area where you hone a skill of identifying extreme overvaluation and trying to time when the life cycle of the thesis plays out, when the market finally comes to realize how overvalued it is. So those are some areas.
And now if we can pick one of those areas and focus on the wealth compounders, as you call them, can you just help us appreciate what it takes to identify such investments and how to successfully invest in them?
So the wealth compounders, there are not very many of them. They're the hardest ones to find that are reasonably priced. So you're looking for great businesses with large growth opportunities, long open-ended growth opportunities in front of them, ideally also with improving economic characteristics, run by competent management, and paying the right price. So the intersection of all those criteria is very rare to find everything that lines up. So it takes a lot of research, it takes a lot of turning over rocks and looking at opportunities. Frequently you'll find a great growth business, wealth compounding business, but it won't be available at a price that's attractive. So I find most often we're casting aside these opportunities because the price isn't right.
And so how do you then generate the ideas? Do you, so you have a database and just keep adding to that database, and then if you could talk about what are perhaps the reasons why such companies become mispriced, and then how do you actually gain comfort that they're undervalued?
Well, idea generation, we use multiple sources. So we have database screening tools that we use, and we have our own screens and lists of criteria that we look for in finding these. So we love unbiased screening, where you can filter thousands of public companies through these screens. We tend to look at things in the growth area. We look at things like high returns on invested capital, or in particular rising returns on invested capital. Top line growth, we look at margin improvement. These are the characteristics of a growth company. There's a virtuous circle going on where the top line's growing and they're getting scale in their business. So we screen thousands of companies down to a few hundred, and then we filter those even further, doing more qualitative exercises like looking at the actual business. What do they do? Is this an attractive business, an attractive niche? Do they have something proprietary? Is this a long-term growth market? Are they gaining share within it? So it's initially quantitative and then a lot of deep qualitative work. And then we get down to a list of maybe 10 or 20 that we're focused on at any time. And then the question is always, is the price right? Can we buy it at the right price? And growth companies, I don't think, lend themselves to traditional valuation metrics, or shortcut metrics as we call them, PE ratios, price-to-book ratios. You need to actually go in and model out the future and express an opinion as to what the future looks like. How big is the market they're in? How fast is it growing? What's their market share? How large will it be 5 years from now, 10 years from now? It requires some assumptions about the future of the world to value these businesses. And then looking at the economics. We love a business that's, say, a small cap company, a 500 million to a billion market cap company that's growing rapidly, maybe 30 or 40% a year. It's not yet showing a lot of earnings leverage. So they might have, say, 5% EBITDA or operating margins, but you can see that that's scaling. Perhaps it was a money-losing business a few years ago, and it's going to be a 25, 30, 35% EBITDA margin type of business 5 or 10 years from now. And I can give you a few examples of those kinds of companies.
Yeah, it would be helpful perhaps either past case studies or a current example that just helps us understand that concept in practice.
So I'll give you a quick prior case study and a current example. So Boston Brewing Company has been one of our investments for a while. This is a business that, if you're familiar, was founded in the mid-'80s by a guy named Jim Cook. Sam Adams lager was their initial product. They now have 59 different beers that they produce. An incredible innovator, craft brewer. They focused on product quality. Started off tiny with brewing one batch of beer and going out and selling it to one pub. And over the years it's grown, and now they have about 1% of the beer market, which is huge growth from where they started, but it's still very tiny in the context of the global brewing industry. And the margins have been steadily growing and growing and growing as they get scale in their marketing expense, in their brewing and their manufacturing and in their distribution infrastructure. And they've got great internal reinvestment opportunities. That's the hallmark of a great growth investment. Finding projects that the company has inside of itself that have very high internal IRRs. So when Sam goes out and builds a new brewery or they invest in a marketing campaign, there's tended to be very high returns on investment. That suppresses the GAAP reported EPS for the company, but it's creating huge value for the shareholders. That's where the market can misperceive the opportunities. They might look at Sam and say, it's trading at 30 times earnings, it's expensive. If the market trades at 12 times earnings, why should I pay 30 times earnings for a company? But in fact, Sam may be a value investment. It might be intrinsically worth a lot more than where it is now. And that's been our view for many points in time during Sam's history. Now recently it's had a huge run, and I think there's less upside. It's more adequately captured by the market, but there's still the opportunity for intrinsic value to grow. But you want to get paid twice, the discount to intrinsic value and then the growth of intrinsic value. So that would be a historical example. One more I'll throw out, a current holding is WisdomTree, which is a company that is in the money management industry. They run ETFs, and it's structured as exchange-traded funds that consumers buy. And the ETF industry started about 10 years ago and has grown very rapidly and become a multi-trillion-dollar assets under management industry. WisdomTree is a relatively small player within ETFs, but you've got traditional mutual funds, open-ended mutual funds, losing share steadily to ETFs. And then within ETFs, you've got WisdomTree, which has started small and is gradually gaining share within the ETF segment. So they're now about a top 10 player. They only have about 1.5% market share and are gaining share because we think they have a better mousetrap. They have what are called fundamentally rebalanced ETFs. Most ETFs are passive vehicles that simply mirror an index. It could be the S&P 500, it could be the Russell 2000, it could be a sub-industry. There's actually been a proliferation of ETFs that have all been targeted to various subsegments. The WisdomTree approach is to use fundamental quantitative research and rebalance their holdings within their funds based upon a dividend yield or a valuation metric, so that as a portfolio becomes more expensive, it tends to sell the more expensive holdings and it tends to buy the cheaper holdings. And research has shown that this system outperforms over long periods of time, and their funds indeed have on average outperformed their peers. And the awareness of their funds has been growing among money advisors, and their market share has been growing, and it's a very scalable business. So they were losing money 5 years ago, and the margins have scaled dramatically as the top line has grown and they've grown assets under management. And it's a fixed cost business where there's a relatively small number of employees running now $26 billion of assets. They were $3 billion of assets 5 years ago. So tremendous growth and tremendous scale. Their margins have now crossed positive. And if you follow the typical path of a money management firm and you model out the fixed costs of the business, you model out the top line, you look at the gross margin structure, they get paid 54 bips on average for their funds. They're in the highest return portion of the business, which is the actual portfolio management piece. They outsource all the capital-intensive, labor-intensive parts of the business. You can scale the business out and see that it's very likely to be a 35 or 40% EBITDA margin business 5 to 7 years down the road. And if you model all that out, it's an undervalued stock, even though it trades at an extremely high multiple of earnings. It's a 40 PE type of stock that we think is undervalued.
Just help us understand, you mentioned they have about 26 billion of assets under management. And where are they with the margins now? It seems a big number, so wouldn't they already be at their sort of margins at that level of AUM?
So at 26 billion, they're at about 10 to 15% type of EBITDA margins. At 3 or 4 billion, they were negative, and that's because they've reinvested in the business. So there's the fixed cost infrastructure to run the business, and then there's the reinvestment in the awareness and the marketing part of the business. And that's actually one of our favorite internal reinvestment opportunities is marketing expense. It's an expense against current income, but it generates growth, which generates scale in the future. So going in and understanding that, the dynamics of the marketing reinvestment are critical.
Tell us a bit more about just how you see the market opportunity then. We've seen such attempts by people like Joel Greenblatt to basically deliver better value to investors out there and compete with these more traditional asset management businesses based on certain value criteria. So give us a sense of where you see the opportunity. How big could WisdomTree get?
Well, it's a very large pool they're playing in. So there's $10 trillion roughly of managed assets out there in the mutual fund world. And ETFs have grown to be approximately 20–25% of that arena. And the reason they've done so is that they're very transparent. They offer daily liquidity, actually intraday liquidity. The cost is a lot lower. So there's a number of key benefits to the fund holder that have enabled them to grow. The problem with these entities is that they're passive. So on average, passive funds have tended to beat active managers. So it's better than the average active manager, but they're not superior to a good active manager. And that's where WisdomTree has changed the equation a bit by using the fundamentally more intelligent-based rebalancing. So they're actually able to beat a larger percentage of active management than the average mutual fund is, while offering the same benefits of an ETF, the lower cost and the intraday liquidity. So there's a number of key advantages that are, I think, going to continue to drive market share growth of both ETFs and WisdomTree within the ETF space.
What would you say is the biggest worry then for you as an investor? You've got to adopt a long-term view, and what worries you the most with this investment?
Well, there's always market risk in these investments. So it's a long-only ETF structure. So when you have a big market drawdown, there's obviously going to be a degradation in assets under management and redemptions. There's always those risks. So that would be one. The other is their continuing ability to innovate. So WisdomTree has been excellent at coming up with new ideas for funds that are creative and well-timed, meaning that they've been contrarian in their approach. They've gone to areas that are out of favor but have a big opportunity. The most recent example being their hedged Japan equity ETF, which is now, I think, about 4 or 5 billion in assets from almost nothing a couple of years ago. They recognized an opportunity in Japan with cheap stocks, an out-of-favor market. They realized that one of investors' biggest fear was the risk of the yen. So they combined in the same fund a portfolio of value Japan investments along with a hedged yen structure. And indeed, Japan has been devaluing its currency in order to rev up its export industry. So they've been able to win on both sides of the equation. But it was an insightful, not obvious, contrarian philosophy that led them to that. That's the opposite of a lot of ETFs that kind of chase whatever the current fads are. But WisdomTree depends upon their ability to keep having those investment insights over time.
And I'm curious how you assess then the, Warren Buffett talks about the danger of looking at companies that may benefit society and that take advantage of growth, but the key thing really for investors is that sustainable competitive advantage to make it a good investment over time. How do you see, against that attractive market opportunity, how do you see WisdomTree maintaining an edge? What is really its competitive edge, and then how can they sustain it? You mentioned that they quickly went from 0 to 4 or 5 billion in Japan, so it stands to reason that there could be market entrants and there could be a lot of competition here.
Well, that's true. That's true. It's a dynamic market, and there's constantly new entrants. It's a very competitive business, absolutely. But it does require that you be trusted to do what you say you're going to do. And it sounds relatively simple to launch a fund to compete in a space, but if you don't have a culture of recognizing a particular type of opportunity, particularly these value-oriented, fundamentally rebalanced, it takes a whole culture and philosophy to do that. It's not as simple as just doing it. And it takes time to build up trust among the advising community that advise these funds for their clients, financial advisors. To earn their trust takes many years of being consistent and following your approach. So that's something they've been building up over time, is this bond with these financial advisors, and that's a virtuous circle that grows over time.
I'm curious, just before we move on, one more question on this business. When one looks around at how the money management industry works, it's interesting. I'd like to say that it's a huge industry that doesn't really have a product. And there's trillions of dollars managed, and it's, in a way, these businesses are really marketing machines. They're not money management businesses. And I'm curious, how excited that gets you in terms of the opportunity for WisdomTree, or is there also a flip side that WisdomTree is a relatively small player, and it really comes down to spending that marketing, and how can they then compete with the juggernauts in that industry?
Yeah, and the juggernauts are the big firms like iShares that have the large scale. They're really out providing a market exposure types of products at very cheap cost, and they certainly have a major role to play. But WisdomTree, I would consider more of a differentiated niche player. And it's actually amazing how much growth WisdomTree has managed to generate without investing the huge marketing scale that these other firms have put in. They've focused on the portion where they can add the most value, which is in the intellectual property of creating the investment ideas, creating the segment, the niche, and then managing the process of doing that. So I see them as a niche player. I also see them eventually. There's always the possibility that they're acquired or become a portion of somebody else's portfolio. I think ideally they'll compound value on their own independently. but I could imagine a world in the future where an iShares or a larger firm wants that as part of their lineup.
Now, when it comes to the wealth compounders, what would you say is the biggest pitfall for investors? And a lot of value investors struggle with these types of businesses. What do you really think is the key to investing successfully and avoiding some of the pitfalls?
I think it's growth expectations not achieved. You need to find those companies that truly can execute against that opportunity. It's very rare for a company to grow at 20% a year for a decade. If you look at the number of companies that have grown 20% a year, 10 years in a row, it's an extremely short list of companies. And it's easy to be optimistic in the early phases of companies' life cycle that it indeed will be that company that achieves a decade of high growth. The odds are against you, because as you get bigger, you've got to find more and more customers, more and more business to generate the next 20% year. So that's where I've seen most growth companies come off the rails, is they can't penetrate the market for that long at that rate. The other one is the business infrastructure, the operating side of the business, not being able to keep up with the growth, cutting corners, cutting quality. See many companies that grow too quickly, and in fact one of our short positions right now is a company with tremendous growth. People love the company. Market's very optimistic. It trades at a very high multiple, but they've started to have product quality issues as they've grown quickly. Building out distribution, building out manufacturing capacity. They've had a lot of issues with putting out sub-quality product and putting their consumer franchise at risk. So those are the two big ones.
And if we take price into the equation as well, not just looking at the business, but from an investor's standpoint, where do you think, I guess, investors go wrong? And maybe I'll just throw out here and ask you, why do such businesses become mispriced? And, what are your favorite sources what are the favorite reasons to actually invest into these companies? When do they become cheap?
Well, valuation is another typical pitfall in growth companies. There's a scarcity of great growth companies out there, and many of them are well recognized. And investors tend to be willing to pay a high premium for growth because it's psychologically positive and exciting to be investing in a business that's growing and moving forward and has its better days ahead of it. That's just a natural human instinct to want to be associated with that kind of a business. So many growth companies are overvalued, and if you run these same scenarios I was just describing, where you model out the top line growth and the operating leverage, you find that you're paying a premium to our view of intrinsic value for these type of businesses. I think the other issue with that too is not investing in a business with no edge. There's a lot of companies, particularly in the tech space, that have high top-line growth but don't fundamentally have an edge. They might have a product or a piece of technology that has relevance for the next 2 or 3 or 5 years, but have little relevance beyond that unless they successfully innovate. And I think that's a key insight, because there's hundreds, thousands of companies we've observed over the years, the tech boom being a great example of many companies coming public with incredible growth, and then 5 years later have nothing to follow up the product with, and top line drops 50% in 1 year, and stock goes down 90%. Traded at 50 or 80 times earnings, and quickly is cast aside. So getting that right, avoiding those type of pitfalls is critical to being a growth-oriented investor.
And when looking at the long side, investing in these wealth compounders, what I'm hearing from you, and correct me if I'm wrong, is that you like to identify these smaller businesses that can scale, so things are going well fundamentally, management is good, and perhaps they're just undiscovered, or people haven't really understood the market opportunity. Or is it to look for businesses that have already demonstrated some sort of growth, management is good, but for whatever reason there's been a disappointment and the stock has collapsed, and that gives you as an investor the opportunity to invest? So
it's both opportunities. They come in both ways. Absolutely finding something young in its life cycle, undiscovered, more folks will discover it over time. That's one category. The other one is
Wisdom Tree would be a good example.
I think Wisdom Tree is a good example of that, though there have been temporary setback issues there as well. One of the great opportunities to buy it recently was an exit of a long-time early investor coming to market with a secondary offering, temporarily depressed the stock because of the new flow of stock coming out. So that was it was actually both categories of opportunity. It was the early in its life phase and temporary issue depressing the stock. So ideally, you can get both to line up sometimes.
And what would you say, and I know you invest globally and in all market capitalization, so how would you rate Apple in this, within this concept of wealth compounders and, whether they're attractive for an investor?
Well, Apple's a fascinating case study. If you remember in 2000, Apple stock thought it was depressed. It was trading at 5% of where it traded at its peak, or actually even lower. I think it was a 50-fold increase or something from the low to the high. It's a business that's always done incredibly well when Steve Jobs was there, and has done relatively poorly at times when he's not there. Obviously had tremendous product success, innovated in a number of categories, music. We've never been an investor in Apple. The big fear with us has always been that business changes rapidly. If you miss a product cycle or two, you can rapidly lose market share in the PC business. There's more diversity in Apple's business than there has been in the past. But some folks had argued that even as it was reaching $500 billion of value, that it was still cheap because it traded at 12 times earnings. I never bought that argument because the earnings can evaporate very quickly at Apple if they miss that product cycle. And if you look at the history of consumer electronics, it's unheard of for a company to maintain any kind of dominance in a consumer electronics category for a decade, much less 5 years, much less a decade. And Apple's had one of the longest winning streaks of any consumer electronic company I can remember for the past 10 years. But at $500 billion of market value, you've got to be incredibly successful at coming up with the next hot thing to generate huge amounts of business. TV might be that thing for them, but I don't know. There's a lot of uncertainty around that. So that 12 times earnings is not nearly as safe as it might appear, because the earnings could drop 50% very rapidly in a business like that.
So smaller businesses that have a different type of business model where you can get more comfortable with it, such as Wisdom Trees, perhaps a better example of the...
I think so, and I'll throw another example out there, which is a new product category which is potentially disruptive to its industry. It's called SodaStream. This is a carbonated beverage company where you have a machine at home in your kitchen that carbonates beverage. You put tap water in a bottle and carbonate it and mix your own soda. It's potentially a disruptive new distribution channel within the soft drink industry and the beverage industry. It's a very small business now. It only does about 400 million, 500 million in sales. It was started in, it's actually a very old company going back 100 years to a UK carbonation technology company. It was bought by an Israeli group, was successful in Israel in the 60s and 70s, and has now been relaunched into Israel and then into Europe. And there's 20% household penetration in some European markets. Recently launched in the US, has about 1% household penetration here. We see it as potentially a very interesting growth business that could be billions of dollars in sales 4 or 5 years from now. It's also a margin scaling type of business. It's a razor blade model where you sell the machine to the consumer at very low gross margin, and then the company makes all of its money selling CO2 replacement canisters and syrup flavorings, which is the more repeat business consumable part of the company. And it offers a number of great advantages to the consumer. You don't have to haul bottles and cans back and forth to your home. It takes up a lot less storage in your house. It's convenient. You can mix up different types of flavors. And there's also an interesting environmental side of it as well. That you're not putting all of these bottles and cans into the landfill. And I think that really plays into the zeitgeist of the American consumer today, of being more environmentally friendly, the Whole Foods kind of mentality in consumer products. So it's not, I wouldn't call it a fully established, proven product segment, but it's growing rapidly. It's going to do about 550 million of sales this year. When we run our growth scenarios out in the company, we can get valuations that are double where the stock is trading now quite easily. And there seems to be a bearish bias against the company. It's heavily shorted. There's a view that it's a fad, a lot like fondue pots or bread makers, that it will be cast aside. But our own research and looking at consumer behavior, the attrition rates, we think the product is actually here to stay. We think it's got recurring relevance. And there's a lot of very interesting guerrilla marketing that's happened around the company. They've had some advertising banned, which is always a great thing in business when your advertising is banned, because it generates a lot of viral free press. And they were banned in the UK with an advertisement because the bottle and can industry lobbied for it, and that created viral interest. They had a Super Bowl ad in the U.S. that was banned because it showed Coke and Pepsi fighting for shelf space while their bottles and cans exploded due to SodaStream use. A very funny commercial that went viral and got 4 or 5 million hits within 48 hours. So they didn't have to pay for the spot and got the benefit anyway. Brilliant management team with background in places like Pillsbury, P&G, brilliant marketers that have tended to do all the right things at the right times. Has a great moat around the business in the form of its distribution because, as I said, the money is made in the CO2 replacement canisters. They've got a great first mover advantage where they've gone out and locked up the distribution channels for consumers to take and swap in their old cans to get the new ones. So they're in places like Williams-Sonoma, Bed Bath & Beyond, Walmart, and it doesn't make sense for a retailer to carry two competing versions of this because of tooling up and training to provide the service. So we think it's a growing, very interesting growing franchise.
And before we move on to some of the other categories of investments you mentioned, just as a last thought, I'm curious to hear how you think about the downside protection then with these types of investments. Or is it really all about the risk reward and you can accept sort of the lack of downside based on that risk reward? Or for example, in the case of SodaStream, how do you think about a downside protection scenario?
Well, these companies are prone to sort of event-driven shocks where they have an earnings report and the growth wasn't as high as people expected, or there's a number off in the adoption of the product. They're prone to sudden resets in expectations. And that just comes with the territory of investing in these kind of companies. And you always need to evaluate, is there a fundamental change in the company, in the business, in my thesis, and be willing to rethink and be open to new information. But that comes with the territory, and as we get into some of the other types of investments, I think it's important to have other more margin of safety oriented, more traditional value in your portfolio to counterbalance these times to give you stability.
So it's very much about assessing that risk reward, and you invest on the basis of there's just an outsized return opportunity if things go well, and if they don't, you do accept that there could be some permanent loss of capital, but that's when the portfolio management comes in.
That's when sizing and diversity of ideas comes in. But I'll point out that, interestingly, sometimes a growth investment can be more resilient than a traditional value investment. So particularly when you get markets like we've seen a lot of in the past 5 years where you get these spurts of macro fears. 08 and 09 was a very acute example of this. Global depression kind of fears creeping in. It's the growth companies, very few companies outperformed. There was very little stock picking value added when you get macro fears and everything correlates. But growth investments tend to do relatively better during times like that because they have the power to grow through a recessionary period because they're gaining market share. Whereas a more mature business is going to be much more susceptible to the ups and downs of the economy. So don't think of the traditional model of a growth investment is riskier, more exposed to market downturns, because it depends on the kind of market downturn that you get. You can also get growth fears like we had during 2000 to 2003 where everyone reset their expectations about growth, what they were willing to pay for growth, because there were a lot of high-profile disappointments as the tech bubble started to crash, and that spread out and all growth investments had their multiples reset. That's the treacherous environment for growth investments. They're more resilient during economic fears.
Perhaps we could then move on to one other category that you described, those investments where there is more of a margin of safety and perhaps a more traditional value investment. If you could give us a sense of how you approach those opportunities and perhaps give a few examples as well.
Sure. We have a portion of our portfolio, we always call it our Ben Graham sleeve. It's about 10–15% of our portfolio. These are really cheap, typically small companies that we buy as net plays, where we're buying them at a discount to their cash and their current assets, their inventory, their receivables, net of all of their liabilities. We look at any given time, in recent few years, there's been 50 to 100 of these type of businesses out there. We went through a long stretch in the 80s and 90s where there were virtually none of these available. This was originally kind of popularized back in the Great Depression when Ben Graham was finding these kind of opportunities in the aftermath of the Great Depression. Buffett was finding these kinds of opportunities in the 50s when he was running the Buffett Partnership. Then they vanished from view for many years. They briefly returned in the 70s, the mid-70s, during the recession and the bear markets of the early 70s. Then they vanished again, and for most of my investment lifetime, they never existed. And I was always fascinated reading these old books like Intelligent Investors, just wishing that someday we'd find these kind of opportunities. Never thought I'd see them. Then 2008 and 9 happens, and lo and behold, there's hundreds of them popping up on our screens. Negative enterprise value, 50% of net asset value, net current asset value. We love to look at that basket of stocks and to see what are these businesses. A lot of them you can cast aside because there's obvious problems going on in the company. It could be a big lawsuit that they're facing. Tends to be the junk. There tends to be a lot of problems in these companies. But occasionally you'll stumble on one where you're getting a discount to NCAV, and you've also got an operating business sitting alongside of that is not losing money and is a call option. So you're buying downside protection through the NCAV discount, and you're getting a call option through the business that's sitting inside of the company. And if you take the time to go in and educate yourself, often you find some really interesting things. And if you see that management owns a lot of stock, that they're buying stock in the open market at cheap prices, you can find other reinforcing attributes. So we've always got a basket of those. We tend to not make them large positions. They tend to be 0.5% of our capital, at most 1% of our capital. You don't have any certainty as to when they'll pay off. I tend to find these are lightning strikes kind of investments. Many of them will languish for years and not pay off. But if one or two pay off, it can really pay for the whole basket, and you tend to not have big losers. I found over the 4 or 5 years that we've been doing these that there have not been any big terrible losers where we've lost large percent of our capital. At worst, it's been sort of a break-even proposition. I also find that they don't correlate to the overall market. You'll find that when market sells off, these kind of stocks just hang in. They're operating on their own timeline. So that's one area of margin of safety. There are some higher profile, larger companies that I think fit this category. One of our current investments is a company, Aflac, which sells supplemental insurance. It's a well-known brand name. It's one of the best-run insurance companies. It's been steadily growing for many years, has a long history of very high return on equity, and it's because they've carved out a special niche in the market where they've got special expertise and have built a virtuous cycle business model. But the stock's available now at a single-digit multiple of earnings. It's as cheap as it's ever been, almost cheap as it's ever been, at least in recent history. It's continuing to generate great returns on equity. They have two main businesses. One is Japan-based, where they sell cancer insurance to some of the healthiest people on the planet, the Japanese. They've spent decades building up a presence. They're highly respected in that market, #1 player in the different segments they're in, and continue to grow and prosper. And they have a U.S. business which sells supplemental insurance. They've built a brand name. They've got great recognition around their duck icon, and I think they're very well positioned for the new era of healthcare, where there's going to be more accountability pushed down to the end consumers of healthcare to be more responsible for their own healthcare and for paying for more of their own insurance. There's going to be more need for purchasing supplemental insurance to sit alongside the new forms of insurance that employers will be providing. So we see a great growth opportunity in the U.S. The stock is very much out of favor right now, primarily because of fears around the yen, the currency issues. People fear that Japan is actively depreciating its currency. Aflac generates a lot of its income based in yen. That's one major source of concern right now from the market. The other is, I think, fading, but still there, and that's the exposure that Aflac had in its investment portfolio to some of the third-tier European sovereign bond markets. They've largely reduced that risk. They've been very transparent about what they held, and they've actively downsized that risk. Additionally, there's concerns over diminishing rates of return in their investment book as we're in a very low yield environment. So as they continue to recycle capital within their float portfolio, the money yield has continued to tick down and down and down, and that's going to continue for the foreseeable future. But if you look at the underwriting profit, which has been consistent and solid, even in a depressed return world, this company is still going to be generating, we think, 16, 18% type of ROEs. Historically, they've been in the 20 to low 20s area. We think that as rates normalize over time, that'll, over the long term, revert back to their more traditional 20 to 22. But even at high teens return on equity, this is a business that I'm willing to pay 2.5 times book value for, 2.2, 2.5 times book value. Currently, book value is about $35 a share. Stock trades at $50, $52. This is a business that's worth substantially more than where it's trading now.
And what about, to come back on the nets, you haven't given us an example because perhaps it's a portfolio approach, right? It's not about any one of those companies. It's more about you have, I guess, 50 or more, similar to what Ben Graham said. You just buy as many as you can and put it in a portfolio. It's not about one company.
I think that's right. It's less about picking a specific winner. It's more about finding a few that have the characteristics you want and treating them as one theme. There are one or two that I might highlight. One I'll point out is a company called Air Transport Corp. Small company. They are in the airport services business. They actually have a couple of businesses. They have airport services business where they run de-icing equipment for airlines. It's a little niche business. They also have an air transport business where they run, for FedEx, they run packages out to rural areas that FedEx doesn't service directly. It's a contract business, cost pass-through type of business. They've been steady businesses over time. They've generated good returns over time. You can buy the company for a very attractive price relative to its cash, relative to its inventories, net of its liabilities. So it's an NCAV play, but you're also getting the call option on these businesses, which have struggled a bit in recent years. They also do some work for the military in terms of equipment, airport-based equipment. There's been cycles in that industry. There's defense sequestration fears. But I think it's an unknown, undiscovered company that at some point gets recognized. An activist investor actually recently began accumulating a stake in the company and has now got a board seat. I think that can only help.
Now, to come back to Aflac, I was curious, sort of just broadly speaking, how you look at valuation with these companies. So on tangible book value, you mentioned you can get comfortable with a premium. And I guess, how do you really do it in practice? You know, the modeling, so even with these types of companies that have a margin of safety, they have the downside protection, the tangible assets, you're focused on growth rather than, and try to find businesses that compound that book value. Is that your favorite sort of opportunity also within this bucket of investing?
Well, I think Aflac checks off both of those boxes. It's a company that you buy at a discount to intrinsic value at today's prices that can grow its intrinsic value at an above average rate over time. With these financial services businesses, you need to be very careful and go in and understand what is making up book value. There's always adjustments that you need to make. It's not simply something you take straight from the accounting statements. You go in and you look at what's inside the book, what are in their assets, are they marked properly, those kinds of issues. You also need to look at earnings, and particularly in insurance, where you can have catastrophic losses. Not at Aflac, that's a more steady business, but you need to go in and make these adjustments for looking at true earnings power over time and come up with a normalized book value, a normalized ROE. But Aflac is exactly that. It's a discount to its intrinsic value, with intrinsic value growing over time.
Again, what would you say is perhaps the biggest challenge of investing in these sorts of businesses within the bucket that you talked about?
Well, margin of safety, the biggest risk we've faced over time, our biggest mistakes have been in not appreciating the rate at which a business is maturing or becoming obsolete. The places we made our biggest mistakes have tended to be paying extremely low multiples for businesses that are in a state of change. And the tech is one area we've had our biggest mistakes, and business services is another area we've made our biggest errors. Not appreciating how technology was affecting the business. Within data processing businesses, for example, there's been a couple of companies where we paid a very cheap price, we appraised intrinsic value to be far above where the stock was trading, but didn't appreciate the rate of margin degradation in these companies, or the rate at which technology was creating new solutions for their customers. So you've got to be very, very cognizant of those kinds of threats.
And I guess would, again, Sony perhaps be one such example where it's just, it may be attractive on some of the parts or sort of relative to even the assets that they have, but is it too hard? It's kind of a too hard pile.
Yeah, exactly, and Dell would be another example of that, where the business is changing rapidly. They've lost their edge in the PC business. That's generated a lot of their cash flow over the years. And you can't underestimate the power of deteriorating business on the overall value of a company. Just like growth is incredibly powerful on the way up, market share loss, top line degradation, as it starts to flow through a fixed cost structure and you start deleveraging your margins, it works the same way on the way down. So you can't go and be a superficial value investor. Just go out and look for cheap multiples and buy a basket of cheap stocks, because bad things can happen to these companies over time. And I think another thing I'd point out, a key characteristic we look for in companies on alongside is owner-operators. We love to partner with management and to have our incentives aligned with management. There are not very many publicly traded owner-operator companies. Of all the thousands of companies, I'd say about 15% of them are true owner-operators, which we define as a company where the people actually running the company own 10 times as much stock and value as the average compensation, total compensation they pull out of the company. And that's salary, that's bonus, and that's whatever options or restricted stock you're getting every year. We'd like to see a 10x ratio of ownership to compensation. By that criteria, there's 15% of public companies are owner-operators.
And that's globally, would you say?
I would say that's a U.S.-specific analysis, but I would think the global numbers probably are not far off of that. We tend to find in those businesses that you're more likely to get things done on a shareholder-friendly basis. They tend to think a little longer term. They tend to do the right things for the long term. Whereas in a more typical mercenary management, typical corporate America, you've got a mercenary management where they might own, 1 times the amount of stock. They own 1 times the stock that they take out in compensation. Their main objective is to make their empire bigger, do acquisitions, grow the company, whether or not it's attractive growth or value-creating growth, get bigger, and expand their empire. That's what we want to avoid. But the true owner-operators, like the Boston Beer Company example, tend to do the right things over time.
And perhaps that's a good transition to talk a little bit about your global approach. And we've got a sense of how opportunistic you are and willing to apply several different approaches. And the focus is always on value, however defined, however available. Where are you finding today the biggest mispricings, or what sort of, can you give us a sense of, in terms of your idea generation, what perhaps categories are coming up, or where, which markets, and which types of securities?
Well, we're finding opportunities everywhere. It's an interesting market. There's some areas are very speculative and have run up, and opportunities have diminished as we've been in a bull market for the past 4 years. But there are pockets of areas where there's still very attractive opportunities. It's not like the whole market has become overvalued. It's still very interesting things to find. Europe is one area where you had 2011 occur, where you had the European debt scare with the periphery countries, and a lot of stocks got very cheap during that period, and we began to allocate more capital to Europe relative to other parts of the world. I can point out one example. I think Porsche is a company that's an interesting, it's kind of an interesting business, undervalued business, plus some corporate structure that creates some additional discount. Porsche became a holding company recently, with its primary asset being Volkswagen stock, as well as some cash and some other very small assets, test tracks and some other things that have some value, but not the big part of the equation. And you can actually buy Volkswagen stock through the Porsche security at a very substantial discount. And the reason for that discount is European stocks generally got very cheap during this 2011 period I mentioned, and have not yet fully recovered. We think Volkswagen is undervalued just intrinsically on its own. Largest auto company in the world, gaining market share. There's a whole positive thesis going on with Volkswagen. But through the Porsche security, you can get an additional 30% discount on top of the already 30% discount that we believe Volkswagen is trading at. And the reason for that discount is general holding company discount that occurs typically in these situations. Plus, there is a lawsuit going on brought by short sellers from an event that occurred several years ago when there was a big short squeeze in Volkswagen stock related to a takeover attempt. And there's a multi-billion-dollar lawsuit out there, both in the U.S. and there's similar lawsuits going on in Germany. And that's cast a big pall over the stock, and there's a big discount. And while it's always difficult to predict the outcomes of these things, I think the relative probabilities favor this not being as bad as the market fears. All of the billions of discount, I don't think will be justified by the ultimate rewards in these cases. You can never say for certain, but if I probability adjust the outcomes of these cases, and you've already seen some dismissals early on in the US version of the case, I think we'll see similar things in Germany. Just thinking commonsensically, the motivations of a court to go and give a large award to short sellers who are not generally the most favored, liked people in the world generally anyway, I don't think we'll get a lot of sympathy from a court. Now there's a lot of mechanics and underlying details that will have to be argued on both sides, but I think when it's all said and done, that cloud will vanish over time or fade away over time. And then the holding company discount will ultimately get resolved because these companies are simply going to merge together. And the lawsuit is one of the impediments to that happening. So as those two events occur, that discount will go away, and then you still have exposure to an undervalued, well-run franchise.
So it's interesting, whereas a lot of value investors perhaps would sort of be satisfied with just owning a cheap stock, I sense that you always look for a catalyst as well that's clearly identifiable to close that discount to intrinsic value.
I think a catalyst is helpful to have. It's easy to get into the thinking that you have to have a catalyst. I don't believe you have to have a catalyst, but the less of a catalyst you have, I think the more discount to intrinsic value you should require. Most catalysts are broadly known to the market. It's very rare that you will find a catalyst that is not understood by other folks as well. So I don't want to overplay the value of catalysts, but all else being equal, you'd rather have one.
I guess it sort of reminded me, that example of a holding company. One comes across a lot of such holding companies that are cheap in Asia, for example, or let's say Korea in particular. Have you been attracted to those sorts of opportunities?
Not so much in the current portfolio. It's not a sort of a line of business that we do going out looking for holding company discounts. I think we come at it first in the Volkswagen case because we liked the business of Volkswagen, we liked the price, we liked the management, and then there was this extra bonus of the holding company structure.
Can you perhaps just to tie in this, we've talked about a lot of, or rather you've talked about a lot of different investments and different approaches. Talk a little bit about the discipline, and the core sort of principles that you still always come back to, and how do you maintain that discipline to be successful in this opportunistic approach?
I think it's important to have a process for investing, to have a series of criteria that you want in an investment, and to constantly monitor the presence of those items. So what we do is, I talked about intrinsic value and upside and downside to fair value. That's one component of what we do. We have an appraisal, like a private buyer would pay for every business that we own in our portfolio, and we're constantly tracking the upside and downside of that fair value, constantly changing the assumptions, updating the valuations, and that's one slice of what we do. That's probably about a third of our criteria. And then we have about 20 other things that we'd like to have present in an investment. Things related to management, things related to economic characteristics of the business, simple things like product quality, are they gaining market share, have they tended to treat shareholders well over time, things that require qualitative judgments in addition to quantitative factors. And we have a score for all of our positions on those different items, and we weight all of them, and we actually have all of it crunched together to an aggregate metric that puts the qualitative alongside the quantitative in one place. And we're always looking at the least attractive things that we own versus the most attractive things that we don't own to see if there's a logical swap that can upgrade the expectancy of the portfolio while also perhaps diversifying us a bit or reducing risk or bringing in another non-correlated investment. So I think it's having the discipline of constantly updating that matrix, constantly understanding the pieces that are inside of that matrix, constantly doing research on new ideas that are potentially better than the ones you own. The hurdle rate to putting a new idea in the portfolio is the least attractive thing in the book. And it's constantly measuring and researching, turning over more rocks to see if something can overcome that hurdle rate, to see if it fits in. And then also constantly evaluating what you own to see if it's become less attractive. Recently we've had a lot of companies that have worked, stocks have appreciated dramatically, and they're not as attractive as they were before. And so we're finding ourselves with the dilemma of, do we sell out, do we pay a tax bill now, what's the after-tax effect of replacing that idea with a new idea? Should we hedge more? We haven't talked a lot about the short side, the hedging side, but there's discipline there as well.
Well, perhaps that is one important topic to address, and of course, idea generation and ideas is just one part of the successful investment equation. You need the portfolio management side as well. So perhaps you could talk a little bit about the, how you size positions on the long side, and also how your hedging strategy and the short strategy helps you achieve your goals.
So in terms of sizing positions, there's always that tension between putting a lot of capital behind your best ideas, concentrating into a few things that you really have conviction in, versus having diversity, which gives you more stability. There's risks in both sides, obviously. The risk of concentrating too much in one idea is that you're wrong, and it can have a disproportionate effect on your performance when you're wrong. And then the other risk of over-diversifying is spreading yourself too thin. It's what you can understand and know. The more things you look at, obviously, the more superficial your knowledge becomes. We found over time that for us, and it's going to be different for different investors, that having about half of our capital in our top 10 ideas is where we feel most comfortable, with our top idea being 5 to 7%, and then about half of it, half the portfolio in the top 10. And then that leaves us room in the bottom tail of ideas to do things like the Ben Graham basket, where they're smaller ideas with maybe more binary outcomes or more unpredictable types of outcomes, the higher risk, higher reward ideas. I think the other thing, and this is an idea from Charlie Munger, the concept of having a pre-flight checklist where you look for red flags, things that are associated with prior mistakes, is a big part of our process too. We have this thing we call the failure index, which is 40 different red flags that I don't do this myself because I want somebody else on our team to do it and to enforce it on me. But every time we're about to put a new idea into the portfolio, this person on our team goes through and does a checklist and goes through all 40 of these items. And if 5 or more of those items are present, then he comes back to me and says, you can't do this. And then we have a big discussion, and more likely than not, it's not going into the portfolio. And so where do we get this list from? It was things that we observed over time we made mistakes on and made errors on. And it actually goes back to my time working in a large money management firm, where I did a project with a couple of other people to look around the firm. We manage a lot of mutual fund portfolios at this firm, and we looked in the aftermath of the tech crash at all these portfolios that had had huge losses, and we did a project to analyze what happened in these portfolios. Was there any learning from it? And we found that in most of the cases where a portfolio blew up and did very poorly, that it was a very small number of ideas that we called torpedoes that ruined these portfolios. Maybe 2 or 3 different investments that were made in large size that had catastrophic declines. And so we asked the next question, were there common characteristics among these torpedoes across portfolios, different managers, different portfolios, different styles? And we hypothesized a list of things. We got everybody's input and went through and tested them and looked at were these red flags present and could have been known before these investments were made or not. And we found a shorter list of those that seemed to have a correlation to these blow-ups. And it's evolved over the years, and we've learned from it over the years, and I feel very strongly about applying that list. And it has saved us from far more losers than it's kept us from participating in winners. It's a very nice filtering ratio.
So perhaps you could share 1 or 2 observations about how you actively avoid these losing investments.
Yeah, actively avoiding losers is a critical concept in investing. We spend so much of our time talking about how to pick great investments. Probably 90% of the discussion is around actively picking winners, but I would say probably 50% of the discussion should be around actively avoiding losers. And it's going to be different for different people. Different investors are prone to making different kinds of mistakes. So you need to, again, getting back to that Ted Williams concept of knowing yourself. It's the same thing with avoiding the losers. Know where your pitfalls are. Know what you get enticed by. Know what tempts you. And then systematizing that into a checklist. It might be a simpler list than 40. It might be just 5 or 10 things for some investors. That if this is present, don't do it. It could be an industry that you seem to always fail in. It could be a characteristic that's present. It could be some feature of management that's there. But knowing yourself. And it takes a lot of reflective study of your past, being willing to dredge up your mistakes and analyze them and learn from them. Do a post-mortem on your bad ideas.
Now, tell us a bit about the shorting aspect of your investment strategy and how it fits within the various strategies on the long side, and how you go about creating that comprehensive portfolio.
Sure. So just as there's success in the market, there's also a lot of failure in the market. The indices, the S&P 500, the Dow, are actually indices of success. There's survivor bias just in those indices. Over time, companies fail and go out of those indices and are never heard from again. And certainly that's true of the broader market. Many companies come public, they grow, and they fail. Some rather spectacularly, some rather quickly. As I talked about with the IPOs, you know, a fifth of IPOs are gone within 5 years. That's a high failure rate. Young companies don't always succeed. Markets don't always go up, they go down. We've seen that particularly in the past 10, 15 years with big bear markets. And we think there's value to be added from understanding what are the characteristics of failure and being positioned for that. So we do most of our hedging through put options, actually. We've learned over the years that for us, put options are an attractive way to hedge because you can know your loss going in. You have a maximum capped loss. It's really just the premium that you're paying for the put. The other thing is I think it simplifies the psychology around running a short portfolio, because if you short to hedge, when you're wrong, the position becomes bigger in your portfolio, it runs against you, and if it acquires significant momentum, it can actually run you over. And but the problem is, psychologically, for many short sellers, is that as a stock goes up, in theory, it becomes more attractive. So it becomes difficult for an investor to downsize a position just as it's becoming more attractive. That's very different with, it's the opposite of a long. When a long doesn't work, it becomes smaller and has a smaller impact on your portfolio, and you're thinking, ah, should I add to it? When it becomes big, it's becoming a bigger part of your portfolio, which you might be exiting and feathering out. But a short, it's a perverse kind of mechanic of portfolio management. The other side of shorting is that as it works, it becomes a less and less effect on your portfolio. So in theory, you need to be adding to a company as it's going down, as it's also becoming less attractive to short. I think puts simplify a lot of that psychology and portfolio management because it amplifies on the way down. It sort of does it for you, adding to the position as the company's falling apart. And it protects you as the company's rising against you, allows you to calmly reassess and reset. The negatives of put buying, though, of course, is you have a finite amount of time for your thesis to be right. It's like buying insurance. If you don't have a loss within the period of the insurance, it has no value. So you have to keep buying insurance into the future. And the other is volatility in the market generally. As volatility in the market goes up, put options become more expensive and therefore less attractive as a form of hedging. So when volatility is low, like it's been in recent past, we tend to do much more of our hedging through puts. And when it's higher, we tend to migrate back more to the short side. So that's the portfolio management side of hedging. The other side of it is what do you short? What's the security selection aspect of it? And our favorite areas are poor business models, unproven business models. Another big area is capital structure problems, where a business has got a lot of debt, or is burning money, or has an event occurring, and it's an inevitable event that's going to occur in its capital structure where it has to raise capital and dilute equity holders. That's another attractive area. And then finally, it's the kind of fads and frauds area. These are more sporadic, one-off kind of things that you find. Fad products. One of ours from a couple years past was the Crocs, the shoes that it grew to a point where they were going to need to be selling 100 million of these shoes in perpetuity, and things like that you could see were impossible. And then the frauds are things that are much more difficult to discover. It's much more just, you just serendipitously stumble upon it. It could be an accounting issue. It could be some contract problem as you dig deep into the filings and read things. But I can mention a couple of example themes currently. One that we've had on for a while is gold mining. Gold has been in a 13-year bull market. There's a whole macro thesis around why people own gold. It initially started back when people were fearful of Y2K. It was kind of a store of wealth, a store of assets. Y2K didn't prove to be a big deal, but gold continued to stay in favor as the stock markets were in a bear market from 2000 to 2003, and then you started to get this reflation argument that started to come into the consciousness, and then it got a life of its own and became almost a cult following, and individuals and retail investors, everyone wanted gold as a portion of their assets. And gradually over the 10 years, it's gotten to the point in recent years where every financial advisor, it's a common accepted wisdom that any person should have gold as part of a diversified portfolio. You should have 10 or 20% of your wealth in gold. The problem with gold is that it has very few practical uses. It's really just a store of wealth. Jewelry, there's very few industrial applications for gold, very minor. But gold, if you think about it, is really just this this sort of unuseful metal. It has to be mined at great expense. It has to be guarded and stored at expense. It only has value if people believe it has value. And in this world where governments are printing money to inflate their way out of the debt that inflicts most of the developed world, there's this view that gold will be the store of value as paper currency diminishes, despite its various problems. We don't have a strong opinion on gold as a commodity, but we do have a very strong opinion on the gold miners. If you go in and do security analysis and look at these things as traditional businesses rather than plays on gold, they look like terrible businesses. They burn cash, they're capital intensive, they operate in risky regions of the world. It's very dicey as to whether or not they actually find the resource. And the costs of mining gold have continued to go up and up as cost of energy has gone up and cost of materials have gone up. And if you look at the cost to extract gold, it's just continued to ramp up. It's actually followed the price of gold up. And for some reason, these companies never seem to generate any real economic profits because they've continued to reach and invest. And in our view, they're over-investing in gold mining projects. And so over the past 2 years, we've maintained a portfolio of put options on what we think are the riskiest gold mining companies. Some of them are large, well-known companies, but most of them are these small junior miners that have been capitalized because it's been easy to raise capital in this business. It's been a very forgiving market for gold companies because it's been so in favor. These companies, in some cases, have leverage. In some cases, they're operating in very difficult places. They have project-specific problems. Some of them even appear to have issues with the geology, the studies that they've used to support their projects. And we're just very skeptical over the future of these companies to generate profit and to continue to raise capital. There's a couple of the very large miners that, there's one in particular whose name I won't mention, but had always hedged the price of gold and always said, view us as a mining company. Buy us for our operational skill in mining. Well, not too long ago they decided to unhedge, given the great pressure that was put upon them by investors that said, we want you to be a gold play. We want miners to be a leveraged play on gold, and we want you to be a gold play. So they removed their hedges. And we just took that as a real sign of kind of the possibly the top or a chain or a pivotal item. And a few of these large companies, I think, could be quite surprising in terms of their ability to withstand any kind of downturn in the market. So it's a bad business model. It's capital structure, running out of cash type of issues. And then there would be no tolerance for gold having any kind of reset. If gold were to decline 20 or 30%, it would be well below the cost of extraction for these companies, and it would exacerbate dramatically the demise of these companies, and some appear to be bankruptcy candidates in a relatively short period of time. So that's a contrarian idea. It's not consensus thinking. It's something that we've stuck to for the past few years. We've fortunately, the miners have underperformed gold, because even though gold has continued to go up, we've basically broken even on this theme. There have been a few smaller miners that have failed, but many of them have not yet. So that's one feature, hedging element for us.
What would you say is the biggest mistake that investors make?
Well, there are a number of things. Obviously, one of them is chasing what's in favor, paying too high of a price for a business that is greatly loved. And you see it in the market today. There's a lot of pockets of great speculation behind certain companies. If you look at the cloud computing area, there are huge valuations being paid for companies, from the big ones down to the little ones. If you look at certain consumer product, luxury goods, consumer product categories, or other areas where people are paying very high prices for businesses, I think that's one area. I think the other one is one we touched on earlier, and that's not appreciating that stocks can be cheap for a reason. Thinking you're buying a bargain stock when in fact you're buying a very troubled company that deserves to be as cheap where it's trading. So those are the two biggest kinds of errors. So
I very much detect this. You got to be different, but you got to be right as well, and you're opportunistic and looking for those opportunities globally.
That's right. The two ways to outperform are to do things differently than your rivals, or to do them better than your rivals. It's very hard to do things better than your rivals. That takes incredible application and skill and experience. To do things different than your rivals is actually pretty easy to do. You can diverge relatively easily, but it's much harder to be right when you diverge.
I'd just be curious, perhaps, you know, when it comes to that global approach, and some of the most contrarian, I guess, places on earth today would be, you know, Russia, perhaps some South American countries like Argentina. Do you ever get attracted to those sorts of places and look for specific securities there, or, you know, do you say, well, actually, I'm not going to look at that, and the price doesn't really figure into the thinking?
We do like to go after areas of the market that are deeply out of favor when you feel that things have reached a point of maximum pessimism. But it's also a question of what can you understand. So Greece is obviously an area where there's been a lot of pessimism. It seems like very fertile ground to go hunting for opportunities. Maybe you find a market where there's been a war. You know, some cutting-edge kind of emerging markets, African markets, or going to a place like Iraq during times of violence. There's all kinds of places in the world you could go for extreme pessimism. But again, it's what can you understand? And we just try to stick to areas where we can get the information we need, where we have transparency, where we can educate ourselves and understand it. And the longer you're in this business, the more you realize how finite bandwidth is, how difficult it is to comprehend the entire globe. So, you know, we like to proceed methodically in areas we can understand.
Is there anything we haven't discussed that you feel is really important to understanding your investment approach?
You know, I think it's being open is the key thing. I think a lot of folks kind of gravitate to areas of specialty and expertise, and our belief is that you have to be willing to re-educate yourself a lot in the market. The market's a complex adaptive system. It's constantly changing. To sort of follow an industry sector and say I'm an expert in airlines or I'm an expert in healthcare, I think very much limits you. I think it's we like to look at the world in terms of characteristics, investment characteristics, and at any given time different things are going to meet those characteristics and not meet those characteristics, and you got to be willing to get educated, to go outside your comfort zone, your area of familiarity, and learn about the new area that meets those criteria.
And what would you say is a good way to develop such a mind, to be open and flexible? How do you go about doing that at your firm? You know, how do you foster that sort of environment, and what are perhaps some resources? What advice do you have to people, you know, perhaps starting out in the business to develop that sort of mindset?
I think it's developing some tools, spending some time as you invest to also step away from looking at particular ideas and build some tools that are going to work for you over time. Having screens, having criteria, having algorithms, having sources of ideas that can be used on a routine basis to go out and screen the world. There's a lot of different tools for this. There's a lot of sort of programming-based models, spreadsheet-based models. Just go out and start building your own framework for investing and have those tools tie back into your investment philosophy. I think it's reading a lot. In this world of constant information, there's more information in investing than there's ever been at any point in my career. The key thing now is to be able to filter through a lot of that information to what's relevant. And a lot of time has come away from just basic reading. Attention spans have gotten very short. It's very easy to get distracted by things during the course of the day. I think it's blocking out time where you can actually read and dwell over an issue or educate yourself for hours on a company. It's a very rare thing now for a modern money management firm to have time available to its analysts and its portfolio managers for thinking and digesting information. That's still, I think, there's great advantages for the individual investor, great advantages for the small craftsman in this business to still succeed relative to these big firms with armies of people. Having worked in these big firms, there's all kinds of bureaucracy, there's all kinds of institutional imperative that exists in these firms that constrains the ability to find these insights that the individual can go out and find. The typical day, if you look at a calendar of a typical person that works in a big money management firm, it's filled. Every day they come in and there's meeting after meeting after meeting. It's hearing a roadshow of a company coming through to pitch to you. It's sitting in an internal investment committee meeting. It's listening to ideas in portfolios that have nothing to do with your own. It's internal company business. It's a lot of your day is eaten up by these things. Their email boxes are filled with things to respond to. They're drowning in information. For the person who can keep the calendar clear and clear their brain and be able to think, it's a huge advantage.
Well, on that note, Chris, I really want to thank you so much for spending the time to share your insights and experience with our audience.